you get dividends on a stock, you're going to get 1099 for those dividends, okay? And it's going to increase your basis. But when you get non-taxable dividends from real estate, then you'll have to pay a lot less tax than on like you would on a normal dividend.
Thank you so much for tuning into Journey with Christian D. Evans podcast. I'm your host, Christian D. Evans. Reach the 0% tax bracket and live a tax-free lifestyle by implementing untaxable wealth strategies. That's the reason why I have this next guest on. I'm so excited about diving into his background and 20 plus years in the investing world. Now, the threat of raising taxes, runaway inflation, and market volatility call for a new way of building and managing wealth. We understand that. That's one of the reasons why we're going to be talking about his strategy and how he's able to design the Untaxable Wealth Transformation Process to show you how to navigate these challenges so you can build and live the untaxable lifestyle, which is what the high net worth and ultra high net worth are really able to focus on. Now, he's helped business owners and executives maximize the benefits that came from the biggest lifetime expense, the taxes they pay, which is what we're going to be talking about. Discover how you can regain control over the biggest destroyer of your wealth, your tax bill. Access the optimal strategy so you can fortify your wealth from economic and market downturn now and in retirement. Please welcome the CEO and founder of Singer Wealth, the one and only Keith Singer. How you doing today, Keith?
Doing great. Thank God. How are you, Christian?
I am doing fantastic, man, and I'm excited about diving into this. And one of the things, before we dive into the untaxable wealth strategies and what you've been able to focus on, the transformational process and all that fun stuff, we're going to be diving in here shortly. One thing we were riffing on before we jumped into this is really, and I just thought this was really cool. I appreciate you being authentic. I want to kind of dive into it, Keith, is how you said gratitude and giving goes in alignment with your successes. And I want to ask you, Keith, during your journey, during your life thus far, at what point was that pivotal moment that you started realizing gratitude and giving coincided and aligned with your success?
Well, I think the big one for me has been giving and gratitude more lately, but I'll get into those. They're a little bit separate journeys on those. However, in 1996, I transitioned from being mostly an attorney to getting to the financial services. It was a career change for me, and I started off really, really strong. I was one of the top new people at a very large financial institution, and I was honored, and things were going pretty well. But then we had a baby, and my income went from 2 incomes to 1 income. We got a bigger house. We had a housekeeper, and every month I didn't have as much money as I needed to pay the bills. Okay. And so what I started doing was I started borrowing money from credit cards, and then I'd flip from one credit card to another credit card to keep the rates low and not pay a lot of interest. And I was pretty much running out of credit. I had no more credit, and I didn't have enough money coming in to pay the bills. And it was a very stressful time for me. And I decided, you know what? I'm a smart person. I'm an attorney. I have a finance degree. Why don't I have abundance? And so I started to study and learn how to get abundance. And I read a few different things. I read a book called Think and Grow Rich about having a certain mindset. I read a book called 7 Spiritual Laws of Success by Deepak Chopra. And one of the laws of the success is called the law of giving. And it stated if you want to have abundance, you have to give, right? Money is currency. So it has to flow out and back in. And, you can give not only in money, but you can give by being generous with your time, by giving a compliment, by whatever it is, you can be generous. And the more you help people get what they want and make people feel good and happy, the more good things are going to happen to you. And then obviously, I look to my faith, and according to my faith, it says you're supposed to give 10% of your income to charity, and I hadn't been doing that. And so I saw this charity that called JAFCO that helps underprivileged kids, abused kids, kids that really have a bad short stick in life. And so I borrowed $1,800 with a little bit left on my credit card, and I made a donation, and almost instantly prosperity started coming into my life. I was out of debt within 8-9 months, and now the more I give, the more I make, and the more I make, the more I give. So I think that's always been an important part of the growth of my business. And it's funny, if business is ever slow, I'm thinking, all right, who can I make a donation to? Who can I help? That's like the immediate thing that pops in my head. So,
well, what I find so interesting,
that's a big part.
Yeah, and I appreciate you sharing that. And when you were in that state, if you can remember yourself in that state, Keith, and there was uncertainty, but you took that leap of faith in giving probably something you didn't have when you were already maxed out with everything, and then you started seeing
that's
that
the best kind of giver.
Yeah. What did that feel like?
You give $1 billion and you give $100 million away. I mean, you don't even notice it, So
yeah. Was that when you were working through that, you mentioned obviously 9 months later you were able to be debt free, but during that journey in it, there was probably still a lot of uncertainty. There was probably a lot of heartache, small little hurdles that you had to overcome, maybe mentally. What were some of those things that you had to overcome to say, I believe this path, I'm going to keep giving regardless?
There was a certain, other changes I probably made along with the way I thought and my mindset. In Think and Grow Rich, one of the things they said is, visualize the future. So I wrote a check to myself for 9 months. I think my credit card debt was like $68,000, and this is back in 1990, 2000 or whatever. And I made it good. So I had $68,000 in my bank in 9 months to be able to pay off that credit card, that debt. And so I think a lot of it is just visualizing where you want to be, and then being detached from that is also you intend to be at a certain place, but you also have to follow the law of detachment and not get so attached to something, because a lot of times people think, well, I'll be happy when I have $1 million, or I'll be happy when I get a new house, or when I get a vacation house, or when I get a new car. And that's not really going to make you happy. Studies have shown that once you have food in your belly and a roof over your head, getting more money doesn't make you that much happier, right? So a lot of people I know, if you ask them, especially if they're successful in their career and they've done well, and I know a lot of people that have come to this country with nothing, and now they have a lot of wealth, right? And they're way ahead of where they ever thought they would have been, right? They're making more than they ever thought they would have made. I know people that make $3-4 million a year, and they said, if I could have made $500,000 when I was starting out, if I knew I was going to make $500,000, no more, I would have signed up for that in 2 seconds, right? So, the thing is gratitude. How to be grateful for what you do have, right? I always tell people, imagine you went to the doctor and the doctor said, I think you have cancer and it's not looking good. We got to do a bunch of tests, but you might not have that long to live. And then let's say you go back a week later and more tests, and the doctor says, this is unbelievably great news. It turns out that the first diagnosis was not cancer and it's something else, and you're going to have a very long life. Okay? You're completely healthy. Think of the gratitude you'd have at that minute. Right? If you thought you were going to die, but now you're not, right? The relief and the gratitude. Well, everyone who's healthy is in the same exact position that they would have been had they gone to the doctor and they were just given a clean bill of health when they were unsure of their health. Except they just weren't unsure, but now they're grateful. I just had a Christian a few months ago. I had a pain in my shoulder and I got an MRI, and it turned out I had a mass on my spine, and I have a thing on my thyroid, and I get an ultrasound on the thyroid and it comes back, it's most likely cancer. And then, I had to get all these PET scans on the neck, and it just turned out that neither were cancer, and I didn't even need any procedures or operations. And, I remember laying on the table, getting that PET scan, thinking to myself, I have a little daughter who's 4 and I have a son who's 8, and I have 2 older kids that are, 21 and 24. And I'm thinking, I'm going to make a video. So if I die, they're going to have something to refer to. Maybe I can give them guidance if I'm not going to be here. And obviously that's a very sad thought. But when I found out everything was okay, obviously the gratitude was overwhelming. And it's funny because the doctor said, you probably would have been better if you never got an MRI because, your neck's pain went away with some therapy, and, it just caused you a lot of stress. But I'm okay with that because it was worth the enhanced gratitude that I got. And I'm still carrying that. Not quite as much as like the day that I found out everything was good, but there's still a heightened level of gratitude even a couple months later. So hopefully I can carry that, continue to carry that.
It is a perspective change, and all of a sudden something happens, and then you start realizing and you become more intentional. I want to ask you, because this is something I've always had to kind of evolve into, and I'm going to ask you how you do it. When you achieve great levels of success, Keith, a lot of times naturally there's, kind of weighing with gratitude or just being intentional with gratitude and giving. And I'm curious, how have you facilitated that intentionality with, as you climb the levels of success and significance, you also have intentionality in regards to giving and being grateful throughout your life, regardless of what happens, positively or negatively. How do you intentionally just focus on that on a day-to-day basis?
I don't really focus on, okay, here's how I have to be successful. I'm giving to charity. But a rabbi did once tell me that if God is your 10% business partner, then business is probably going to be pretty good. And so, we're focused on just continuing to scale our business, helping more people. And that's a challenge because when you become a financial advisor, you know about investments, you know about planning, and you know about taxes and how to pay less taxes and how to counsel your clients on how to plan, and also I'm an attorney, so estate planning and legacy planning. But they don't really teach you how to run a business, how to manage people, how to make sure that you hire the best people so that your company can grow in the best possible way. And that's sort of a challenge. And one of the things that helps me with that is, I've spent a lot of money on different education. Obviously I have a law degree and a finance degree, but they don't teach you necessarily how to run a business. I have to go outside of the traditional education for that. I'm part of, groups of people that do exactly what I do. And we share ideas and best practices. And, we're trying to get the best possible results for our clients and give them the best possible experience.
So with gratitude, I want to kind of just jump on this a little bit. It's now generational, where you have obviously learned this, you're intentional with this, but how do you teach your kids and your family to, focus and being intentional holistically as a unit in gratitude, in giving your resources and giving your time and giving your energy? How do you navigate that?
I have an interesting take on donating your time. Let's say I've seen guys that are making $5 million a year go work and build a house in Habitat for Humanity, right? They give their day to help build a house, okay? I think that's inefficient philanthropy, okay? Their time is worth $5,000, $10,000 an hour, right? Why spend it on $50 an hour work for the charity? Give them a day of your time and money so they can hire hundreds of people to build houses, right? So I think the best use of my time is to make money, because the more I make, the more I can give. As far as my kids, my 24-year-old is already, he's working. He's a real estate analyst, and he's doing really, really well, and he's tithing. And I'm proud of him for that. And I think my next son, he doesn't have a job yet, but, I think he'll be, he has that mindset as well. So
awesome. Well, I want to talk a little bit about your untaxable wealth strategies. One of the things that I found interesting about your thesis, Keith, is you talk about how really regain control over the biggest destroyer of your wealth, which is your tax bill. And that's what you mentioned. And I found that very interesting because it's like you're going to war against the tax bill. And I thought that was really cool. But Keith, in your journey, being in the financial world for many years now, when did that come to light for you, where that became kind of your sole focus in helping a lot of these high net worth, ultra high net worth, decreasing, that tax bill, and that will be the biggest destroyer, whether, it be now, whether it's future. Obviously, there's some political things you can't control. You have things you're not able to, control at a macro level, but there are certain things you can't control in-house in your strategy that can decrease that. So at what point in your life did you start realizing, okay, this is it. This is going to be my hill that I die on, if you will?
When I first started, I was mostly working with people that were my age, younger people that were saving for retirement, because I was an attorney and someone came up to me who was a, financial advisor and said, "Hey, let's have lunch." And so we had lunch and he said to me, "What are you doing for retirement?" And I was thinking, I don't really have a plan or anything. I have some stocks, and I play the market, but I don't have a plan. And he showed me this plan, and he showed me how it could grow tax-free and that I'd be able to take tax-free income. And then he recruited me when he saw how interested I was. So ever since I've started, when we're planning for retirement, you want to basically figure out how to create wealth, right? And so what you're doing is you can create wealth a few different ways. Number one, you can hit a home run in business, right? You could sell your business for a lot of money, or you could get some sort of fortuitous event. Maybe you got a lawsuit or an inheritance or something, or you could systematically save, right? And the only thing that's not tenuous is to systematically save. So if you're going to systematically save, then you need to be tax efficient. And one of the tools that a lot of people use is their 401k at work, if they have a job that offers a 401k. And so that's good because you get to put money in pre-tax, which is good. It all goes tax deferred. However, there's a few problems with traditional qualified plans. One of the problems is that there's a lot of limitations on how much you can put in. So if you're a business owner and you're trying to set up a plan because you want to maximize what you can do, you have to generally put a bunch of money away for all your employees. So if you have a lot of employees, the cost for putting away money for the employees is more than you're going to save in taxes, right? Number two, there's limits to how much you can put in. And so people need other ways to save. And so one of the things that we do is we use non-qualified plans. About 80% of Fortune 500 companies are using non-qualified plans for their key employees. And you can put unlimited amounts of money away. You don't get a tax deduction, but all the money goes tax-free, and you can take income out tax-free as well. I know that Jim Harbaugh, the coach of Michigan, Michigan puts a couple million away for him in a plan like that. And so, that's one of the things we've always tried to do. I know I do a lot of that for myself. Definitely over 6 figures away each year in plans like that for myself, and my wife and my kids all do it too. And the thing about the 401k and the IRA is that a lot of people have been putting money away in 401ks and IRAs, and the government's your partner now, right? Imagine, Christian, that I say to you, all right, Christian, I'm going to lend you $1,000, and when it's time to pay me back, I'll tell you how much interest you owe me. Does that sound like a good thing to do? Because that's what the government's done, right? Whatever tax bracket we decide that you're in, when you retire, that's how much you have to pay us. Okay. And so it used to be, at least with IRAs, you could just take out the minimum each year, and then your kids, when they inherited it, they could take out the minimum each year. But now they have to take it out within 10 years. And that alone could put them in the top tax bracket. And if they live in a state where there's state income tax, they could be paying 50%. Now, you're familiar with there's this huge deficit, right, that we owe as a country, $31 trillion, and there's a debt ceiling. And the government can print more money as long as we can raise the debt ceiling, as of, first quarter of 2023, there is an impasse about whether the Republicans are going to allow a debt ceiling increase. And it looks like they mean business too, and they're wanting major cuts from the Democrats before they'll agree. And so we're already out of money. We're just, shuffling things around as a country right now to be able to continue to pay the bills, right? Like, imagine you're out of money, but, you're allowed to borrow money out of your IRA for 60 days and then put it back without a penalty. That's kind of what we're doing. We're shuffling things around so we can still pay the bills. And so if they don't raise the debt ceiling, which at this point, I wouldn't be surprised if they didn't, they're going to, have to lay off workers, and it's going to get ugly. And it may be where things get really ugly, there's an outcry, and then everyone, finally says, all right, fine, we'll raise the debt ceiling. But, the government spent a lot of money during COVID, like when our debt went crazy high, and, a huge amount of our debt is going to pay Medicare, Social Security, and obviously the military, and the interest on our debt is a big one. And now interest rates are higher, so now the interest on our debt's even higher. Okay? And now we have to pay that extra interest. And so either we have to cut costs, we have to cut spending, which isn't popular to do, or we have to raise taxes, which isn't popular to do. I don't think we can just keep kicking the can down the road without making some changes. And so there's a good chance that they're going to have to raise taxes. And so when you have an IRA, you can dissolve your partnership with the IRS either one of two ways. You can strategically do it to pay as little tax as possible and proactively do it, or you can just kick the can down the road and then pay a huge tax bill at the end. What's interesting, Christian, is if you're 65 years old and you have $500,000 in your IRA and you are making 8% a year on that money and you live 30 years, do you know how much tax you're going to have to pay? You and your family are going to have to pay on that $500,000 if you just take out the minimum every year and then your kids take out at the end when they have to take it out. It's a weird number. It's $1.2 million of tax on $500,000 because of all the growth that's going to happen when you grow your money. Money grows, the more it grows, the more tax there is. You could proactively, probably in most cases, dissolve that partnership in the next few years by converting to a Roth IRA and pay about $120,000 instead of $1.2 million. Okay, and that's assuming that your kids are in the same tax bracket as you, not that they're going to be in a bigger tax bracket because they have to take all the money out over a short period of time, or tax rates went up, or they live in a state with state income taxes. It could be a lot worse. So part of our planning is taxes, right? How do we pay as little tax as possible on our income? Let's say you have a capital gain, you sell a business. We have a lot of clients that have sold businesses, and all of a sudden they have $10 or $20 million capital gains. They sold a piece of real estate. There's strategies that we can implement so that they can defer those taxes or eliminate those taxes. And that's part of what we do as well. So it's important that when you're working with an advisor that you strategize about, well, how can I pay less taxes both now and in the future? Because a lot of people think their accountant will tell them how to pay less taxes. The reality is their accountant will account for how much taxes they owe for last year, right? They're not going to plan so that in 3 years from now, they'll have as little tax as possible. They may say, put more money in a retirement account or throw money in an IRA this year, which will reduce taxes this year, but it won't necessarily reduce your taxes over the long run.
Interesting. So he's really got to not only thinking about now in the present and what happened in the last 12 months, but it's really navigating the future as well as anticipating what that's going to happen. Whether that's, when you're hit 59.5, 60, whatever it is, and whatever that's adjustment. You mentioned a lot of key points, but I want to loop back on one thing you mentioned. And I always find this very interesting because I'm noticing a lot of businesses, whether you're running a 7 or a mid 8-figure business, I've talked to a lot of founders, and they're gravitating more toward 1099s, because I think you mentioned something which I found very interesting, because yes, you could have people W-2 in-house, but there's a lot of different benefits you could add on there, health and whatever. And there's a lot of incentives, incentivized ways of doing that for retirement purposes, for whatever. But when you're a 1099 employee, right, of a company, you don't have to, the company doesn't have to actually give out a lot of that stuff. And so you mentioned something, and I want to talk a little bit about this. At what point do you think sometimes by having someone in-house, W-2, giving them all those offers outweigh the cost of it? So like the tax incentive outweighs the cost of it in regards to just building out your company and your culture. Because I do know culture, a lot of people want to get hired by, all the benefits and all the features and all that fun stuff, but also 1099 on a tax, margin basis, sometimes might be more profitable as well, because it offsets, you as the employer, that you don't have to pay all that cost as well associated with it.
Well,
so how do you look at that? Because you mentioned that.
Sure. There's certainly a lot of tax benefits to having independent contractors versus employees. With independent contractors, you pay them what you owe them, and then they get their own benefits. They pay their own Social Security. With employees, the employees pay about 7.25% Social Security tax, and the employers match it. So, and then if they have health insurance, you're paying for that. But you can't just make anyone an independent contractor. They really have to be independent. So our employees are employees. We have certain advisors that are independent because they can do what they want. They can work when they want. They don't have to be in an office at any specific point. They can they're in charge of their own situation. But the employees that we direct and tell them to be in the office, they're W-2 employees, But like our advisors, we give them the option, if you want us to pay you W-2, we will. But if you want to be 1099, there's some benefits, because then they can deduct certain expenses that are related to their business and reduce their federal income tax. And that can be, very, very valuable to them. Whereas if they're W-2 employees, you can't really deduct that stuff. So,
well, yeah, that makes sense. And that's why I'm always intrigued to see kind of what the cost benefit is on that. Let's kind of dive into a little bit where you mentioned other different strategies. I know we've talked, and I know real estate is a very, very big, investing strategy, definitely with, accelerated depreciation and other things like that really help, mitigate that tax bill tremendously. What are some underutilized, in the real estate space specifically, underutilized strategies that individuals are underutilizing in regards to the real estate?
Private real estate has a really underutilized asset class. Since 1992, if you look at all the rolling 10-year periods of the stock market, it's averaged about 7.5%. But the worst 10-year period was negative like 1.5% a year for 10 years, which means 100,000 became 70-something thousand. Okay. But with private real estate, the worst 10-year period was positive 6% a year. So when you invest in private real estate, oh, by the way, the average return was about 9.5. So not only is there a better historical return with private real estate as an asset class, but you also have less volatility, less up and down, which is less risk. And there, as you mentioned, Christian, there's really good tax benefits. So what happens is when you invest in, let's say, a private REIT that buys apartment buildings and they're collecting the rents and they're paying you out 6% a year, well, what'll happen is the depreciation of those buildings will flow through to the shareholders. So if you put in 100,000, you might be getting 6,000 a year of income, but your 1099 at the end of the year might only be for $500. So most of that income is non-taxable because it's offset by depreciation. So if you like getting non-taxable income or tax-favored income, then real estate is certainly one way to do that. So what will happen is, let's say in 10 years you sell the investment, you'll recapture all that income that you didn't pay tax on, but you'll only have to pay capital gains taxes on it. So you'll get tax deferral and lower tax rates when you do actually sell. And if you never sell, you'll get a step up in basis for your business.
Let me ask you this. And I've had some people play the long game where they deploy. Let's just go with that example: $100,000, you get $6,000 back, okay, a year. But they don't take that $6,000 and dividend contribution. They just reinvest those dividends for the next 5 years, right? So naturally, we see that upscale. Sure. But now, because of that circumstance and that situation, because you're not taking, distribution of that, you don't have to pay taxes. Just want to reiterate that for our audience. Is that correct, Keith?
Right. So, well, you're going to have to pay income taxes on the same amount of money that you would whether you get it in cash or reinvest it. When you get dividends on a stock, you're going to get 1099 for those dividends, okay? And it's going to increase your basis. But when you get non-taxable dividends from real estate, then you'll have to pay a lot less tax than on like you would on a normal dividend or on interest that you were getting.
How does this differentiate from syndication? Syndication is slightly different because the tax can only offset. See, if you made a lot of money in your business, and you can offset that from taxable income, but in a syndication you can only offset the appreciation or your dividends, the depreciation from other rental property income. Is that correct?
Yeah. So if a lot of what happens, the tax laws there's a dichotomy. If you are a real estate professional where you spend a certain amount of time, I think it's 750 hours a year on real estate, then when you have passive losses from real estate, you can offset that against other income. But when you're not a real estate investor, or your spouse is not a real estate investor, then you can only use the losses to offset that investment, gains on that investment.
Okay, I'm tracking, definitely.
Okay,
appreciate you reiterating that for our audience as well. Gotcha. Let me ask you this, Keith, because one thing we were talking about offline before this is you talk about the alternative investing space, and you basically say, don't rely on the cookie cutter 60-40 split portfolio, which is what normal wealth managers kind of, gravitate toward, definitely for middle income individuals. You talk about really alternative investing in the private equity structure and really investing, a large portion of that because that's got a good internal rate of return. I could say a few things in regards to that industry. It's really, really incredible and sexy. But Keith, when you're having that conversation with your clients, why do you gravitate toward that kind of thesis more so from that original 60-40? And like you mentioned, don't rely on the cookie cutter 60-40 split. I find that very interesting, and I think it's a good point. I'd love to reiterate it.
It's interesting. In April of 2021, I was interviewed by Money Magazine about the 60-40 portfolio. I said they're antiquated because when interest rates are 7 or 8% and the safe part of your portfolio is making 7 or 8% interest, that's fine. But now when interest rates are making 2% or less, then you're taking a lot of risk because if interest rates go up, you could lose a lot of money. And if they don't go up, you're only making 2%, right? And so we have been telling people don't buy bonds. And what happened in 2022 was the worst period ever for the 60-40 portfolio because stocks are down 20% and bonds are down 15%. So the bonds had a lot more risk than people anticipated or appreciated. And so we were saying, look, let's do other things. Instead of buying bonds, which have fixed coupons, let's invest in private credit. Now, there's 2,500 companies in the United States that are publicly traded that have over 100 million of revenue. There's 18,000 that are not public that have over 100 million of revenue. And those companies like Burger King and Nestle, they can't issue bonds, but when they need money to expand, they can't really go to banks. Banks aren't really lending in that space, so they have to go to private credit funds. And so usually they're going to borrow money for 2 or 3 years to use it for capital improvements, and then they'll pay it back. But the rates are 9-10% interest that we're getting on those, and they're floating rate loans. So if interest rates go up, we make more interest as investors. If interest rates go down, we make a little bit less. But now we don't have interest rate risk. So why do bonds go down when interest rates go up? Well, as we've seen, if you buy a 2% treasury, it's very safe in terms of credit risk. The U.S. government is going to pay you back your money. If it's a 10-year treasury, they're going to pay you 2% interest a year and then pay you back your money in 10 years. And you can pretty much bank on that. But when interest rates went up to 4% and now you want to sell your bond, who wants to buy a 2% bond when they can now buy a 4% bond, unless you're willing to sell it at a big discount? Which is why when interest rates go up, the value of your bonds go down. That's what happened. That's why treasuries went down so much in 2022. Now, if you have floating rate, right, if all of a sudden I had a 2% bond, but now it's paying 4%, right, I can still sell it for the same amount because it's paying market interest. I didn't lose money. So when interest rates are low, if you're a borrower, right, on your house, what do we want to do when interest rates were at all-time lows? We wanted to refinance and get fixed, lock that in for 20, 30 years, right? Refinance. Everyone who refinanced is super happy, and everyone who didn't refinance is now kind of bummed. I did it for my house, but I neglected to do it for my house in New Jersey where we go in the summer, and now it's going to reset in August, and I'm like so annoyed that I didn't have to think about how the time to refinance it. And so if you're a lender and interest rates are low, you want floating rate, right? Because if interest rates go up, you want to make more interest. So that's what we were telling clients, buy private credit. And what's interesting, Christian, is that since 2004, private credit has averaged about 9.2% a year total return, and investment grade bonds have averaged 2.4 in the same time period, right? But investment grade bonds, you'd think, all right, well, they're safer, but they actually had more risk, more volatility than private credit funds. So the name of the game is make as much as you can for as little risk as possible. And private credit is definitely an underutilized asset class when it comes to, and that is an alternative, right? So you mentioned, all right, so what are we doing instead of 60-40? We're emulating the very wealthy institutions and endowment funds. If you look at Yale University, they manage about $30 billion of money for Yale. Now, why Yale needs $30 billion in their endowment fund, I don't know. I guess that's another conversation, but they do have it, and they have smart people managing it. And they are not investing in 60-40 portfolios. You know, in the 90s, they probably had 60 or 70% U.S. equities and international equities. Now they have about 20%, 30%. They have private equity, private credit, leveraged buyouts, venture capital, structured notes, all different kinds of investments that they can make that aren't correlated in the stock market. And that, historically have a better returns.
Well, that's one of the reasons why maybe about 3-4 years ago, I became very aware of these different asset classes that only the high net worth, ultra high net worth, you have to be a accredited investor to be able to get access to this. And you see, and I noticed like a lot of private equity, there's a lot of dry powder sitting on the sideline, ready to be deployed. That market in general is going to go from like several $1 trillion added into it, which is incredible value. There's a lot of stuff going on, definitely in the secondaries. And you mentioned kind of the internal rate of return and so forth in regards to like that up to the right trajectory and with a lot of these asset classes. But I want to talk a little bit about, you mentioned here, the private credit side. One, I do like where it's got a lot of opportunity for the little risk. So a lot of, the opportunity is very, very, very attractive. So I'm curious though, how, because I know private equity, yeah, I know private equity and I know real estate and other, alternative investing, it's non-liquid assets a lot of times. Some are more liquid than others. What with private credit specifically? Yeah, go ahead.
So you mentioned that historically these alternative asset class, private credit, private real estate, private equity, has only been available to very, very high net worth or institutions. And that was true. And then there's been an evolution. You needed, all right, to be a qualified purchaser now, you just needed $5 million in net worth to be able to do it. And now a lot of these are for accredited investors. You just needed to make $300,000 if you're married, or $200,000 if you're single, or have $1 million of investments, to be accredited. And so, but the thing is, the traditional structures don't work for people that have, only $1 million, right? Because they don't necessarily want to tie up their money for 7, 8, 9 years. So now there's in private credit, private real estate, and private equity, there are different structures that are 1099. Minimum investments could be $50,000 to $100,000, and there is liquidity. Generally, they are what's called interval formats, where every month you can redeem your shares back to the sponsor for whatever the net asset value price is that they determine. For the same price they're selling it to new investors, you can sell it back to them. Now, that's provided that there's enough liquidity. So typically they will cap 5% a quarter of the total outstanding amount of shares, because the money's invested in companies. It's not just sitting in the bank, where if everybody wants their money back. So if everybody, for a lot of people, wanted their money back one quarter, you may not be able to get all your money back that quarter. You might have to get half your money back that quarter and try to get the rest the next month or the next quarter, depending on the fund. So there's a lot more liquidity than there used to be. But it's interesting. I was talking to one of the private equity funds that we do a lot of work with, and they have always had these traditional structures, 7, 8, 9 years. What happens is, for listeners that don't know how these private equity funds work, the traditional structures, let's say you commit $250,000 or $500,000 or whatever you are committing to invest. When they close on an investment within the fund, they say, all right, send us 10% of the money now. We need it. But until they actually deploy the money, they don't ask you to give it to them. So if you commit 500,000 or 250, you might not actually have to come out of pocket that amount of money, because you might have gotten profits already that were utilized internally to be deployed for your future capital costs. So we just had one where it was on a $250 commitment. They only called it $125, and then they're done because they've already made enough profit to cover your additional contributions. Like I was saying, this sponsor, very prominent private equity firm, they came out with this interval fund, and they had one of their institutions say, we like that structure. We're going to put $50 million in that, because we like the fact that we could potentially get some liquidity. We like how this is, the fees are very low, and let's do that. So I think that you really can get access to some really great private equity with as little as $50,000. I mean, we've had private equity funds that for 2022 were up 16%, and the S&P 500 was down 19 or 20. So having some of your stuff go up a lot really can offset, the stock portion, which everyone's stocks were down in 2022.
Let me ask you, let's get a little micro in each one of these alternative investing a little bit, because for those that aren't aware, in the private equity, there's a lot of different investment thesis, right? There are some that just focus on, 2 million EBITDA and to $10 million EBITDA businesses, and they help them scale and grow and whatever. There's just all sorts of different investment thesis, and I could just keep naming a ton. And there are also fund approach. And then even within the real estate game, as we all know, there's a different investment thesis as well. Maybe they gravitate, that investment thesis, hospitality kind of in real estate. Some are more multifamily, some are more, class A, some are, value add, whatever it is, right? My question really comes down to this, Keith, and it really is probably contextual. I would imagine it's very contextual, depending upon obviously your clients' goals and where they're at and what they want to achieve, et cetera, and maybe the internal rate of return, maybe some of the metrics as well. But I want to ask, when you're looking at the massive amount of alternative investing strategies and opportunities, what is your methodology or the way you think about it to find the ones that align with your client's investment, goals and the opportunity, and as well as that vehicle that you want to deploy and infuse capital? How do you guys approach it? How do you guys think about it? Definitely in this industry, we see that there's a lot of opportunity, but there's also a lot of choices out there, and you obviously want to filter away all the really bad ones and focus on the ones that obviously produce the best.
Pretty inundated with different investment companies pitching me to recommend and have my clients invest with them. And I only have so much time to do due diligence. So I tend to just gravitate towards the very biggest names, the Blackstones, the Apollos, the Hamilton Lanes, companies that, Cantor Fitzgerald, companies that are very prominent, that have great reputations. And then I hear what they have to say, and the investments that appeal to me are the ones that we utilize. but only with the very best sponsors, the very best companies. That's really our philosophy, and it's worked really well. You know, if I put someone in a Blackstone deal, I don't think I'm ever going to have to apologize. If I put someone in a no-name small little real estate deal because it sounded good and it goes under, that could be looking pretty bad on me. So I don't want to put myself in that position.
No, that makes sense. I appreciate your honesty in that regard, and you obviously stick with the big names because obviously they've already got the tailwind behind them. When you're
great, they know they're great at what they do. You know.
Yeah, that's good. That's good. No, you're good, man. And I want to ask, so let me, what I find so interesting about the alternative investing space is it's so fun and there's a lot of opportunity with it. But do you ever get into, or what is your thesis or the perspective on secondaries? This is a little fragmented. This is more kind of individual in regards to, deploying capital into a specific company that is in the private markets, that have access to it. I know a lot of employees right now I'm seeing, because I got some people that are right on the forefront of liquidating some positions in these private held companies because they need, money for whatever reasons, whatever purpose. So there's a lot of conversation in regards to, people are deploying capital in the secondaries specifically. Do you gravitate toward that, or do you like more of that fund approach?
Yeah. I literally just sent out an email to our qualified purchasers yesterday about a Blackstone secondaries real estate fund. What they do is they buy people out of their funds that are not liquid, and they pay a discount. And obviously they buy the ones they think are the best ones. And for our fund, for our secondaries fund, so 3.5 years ago, people who committed $250,000 only had to put in 125. That's what I was talking about. And they pretty much doubled their money in 3.5 years. So now Blackstone's coming out with the second one, another one, the next version. And so, we're excited about that. And I'm going to invest in it. And, it's one of the better opportunities to make money is to buy things at a discount, take advantage of, the economy, what's happening right now. People need liquidity all of a sudden, and they can't get out of these investments. And so they're going to get a haircut to get out, and that'll be to the fund's benefit.
Awesome. Okay. Gotcha. Well, that's cool, and how they focus on that. I want to talk a little bit more macro now. U.S. obviously has really, obviously scaled, tons of incredible internal rate of return opportunities, a lot of capital infused within the last few years, definitely in the VC and the PE world. I'm going to talk. I had Dr. Mark Mobius on the other day on our podcast. His episode should be released, but he's really focused on emerging markets. And I want to get your thesis. There's a lot of, countries, Israel, a cool tech sector. You got China, of course, very well known, very prevalent, taking, leaps and bounds. Other different nations, we're even seeing India, potentially within the next 10 years, really, really scaling in their economy and their opportunities, even Brazil. So I'm curious, Keith, what is your perspective on emerging markets and the opportunities there? Do you feel like it outweighs the opportunity, or do you feel like internally here in the U.S. is still, there's still prevalent opportunities?
There's always going to be times when certain markets are in favor and certain are out. And in emerging markets, there's probably going to be bigger upside and bigger downside. I will say that I visited the Tel Aviv Stock Exchange a few years ago, and I met with some of the tech companies there. And in our model portfolios, we do have a slice of Israeli tech. We have an Israeli tech ETF, and all I invest in is Israeli tech companies. I was super impressed with the things that they're working on there, and the technology they're coming out with in Israel. They're really, really smart what they're doing over there. So we have actually exposure to that. That's our really only exposure to a single country would be Israeli tech.
So when you say there's ups and downs, do you mean like the risk is high, but also the opportunity is high, and you have to navigate that accordingly? How do you see that? Yeah,
we're generally trying to avoid for our clients high variance, right? So our clients that want to retire, that don't want to run out of money, they want to plan so that even if the stock market isn't great, they're still going to be okay. Because if you look at the stock market, it's made 8 or 9% over the last 70, 80 years, maybe 10%. But if you look at all the different decades, there's lots of decades where it lost money, even 30, 40, 50% after inflation, right? So if you look at from 2000 to 2021, $1 million in the S&P grew to almost 5 million. That's if you didn't touch it. That's if you just let it ride and reinvest it. And then by 2022, it was down to 4 million, right? Because it was down 20%. But that's like a 7.5% return over 21 years. So if I said to you in 2000, all right, I have a crystal ball. I know that the stock market is going to average 7.5% per year for the next 21 years. Why don't we safely take out 5% a year from our money, and each year we'll take out a little bit more for inflation, and we should be fine because we're only taking out 5 and the market's growing at 7.5. But the reality is, if you had done that, you would have been out of money in 2016 because there were some bad years. And then if you had to take money out when there was bad years, you have what's called sequence of return risk. So if the bad years happen early, then you're bad. It's bad for you. If the bad years happen later, you're fine, right? So you want to make sure when you create your plan for retirement is that you have a portfolio that has as little variance as possible. If you're going to average 8%, in the bad years it's 0, in the up years it's 15, right? You don't want the bad years to be negative 37 and the positive years 28, okay? And so we use different strategies to try to get as close to our expected return each year as possible. Like if I said to you, all right, I can sell you a CD for 8% for the next 10 years, how easy would it be for you to plan? Right? You know exactly how much you're making, exactly what you're going to be able to spend. But if I say some years you make a lot, some years you lose a lot, it makes it a lot harder. And so if you want to have peace of mind and not start thinking, oh, I'm worried about running out of money, or you get anxiety because you look at your account statements and you see they're down, then you need to do a lot of things in your portfolio that can do well even if the stock market doesn't. And so adding emerging markets in there isn't one of the things that I'm thinking is going to help our clients achieve their goals.
So it's really navigating it in more of a cautious way. Sure, you deploy it, but it's like money that you can lose. You're not relying on it for your growth, goals. It's more of like the approach a lot of VCs have. It's I'm going to deploy capital in a lot of companies, and hopefully some will win in that fund approach. But if they don't, that's okay. It wasn't like I needed the money to pay my bill tomorrow kind of approach. But
right, and so if we ask people when they meet with us, do you want a portfolio that's going to give you the chance to make the most possible money, or do you want a portfolio that's going to let you live exactly like you want to live and not have to worry? Right? People are usually saying the second one.
Yeah.
So that's why we're trying to accommodate that.
Okay. I appreciate your perspective on the emerging markets. I was just curious because there's a lot of excitement in those emerging markets, but I like the way you navigate that. It's like, yes, there's opportunity there, but you got to also understand the volatility of the ups and downs. You can't put too much and deploy too much in that in your allocation portfolio.
And you mentioned venture capital. So venture capital, by the way, for those that don't know, is a form of a private equity investment. You're investing in a company that's not publicly traded. But venture capital means they're a very young new company that doesn't necessarily have earnings yet. They might have an idea, they might have a product. It takes a lot of money to develop and work it out, but the upside is really, really big. But it could be a very binary investment. You could be worth 0, it could be worth a lot of money. Whereas leveraged buyout is much more mature companies that are making money, and you're buying them at 6 or 7 times the earnings versus the S&P 500, you're paying 20 times earnings. And so that is what we're focusing on when we are doing private equity, is we're not really looking at venture capital for our clients. We're looking at leverage buyout, more mature companies.
Great synopsis real quick. And I appreciate you kind of reiterating that for our audience. Keith, man, I really appreciate you being on here big time and just talking about your gratitude, your giving, the way that is aligned and being intentional with your success and being able to be significant as well as and giving back to so many. But also, talking about the way you navigate and think about alternative investing and these different theses and the way to, navigate that with alignment with your clients and having those conversations and dialogue and unpacking the different, taxable and non-taxable wealth strategies for your clients as well. There's just a lot of fun things that we discussed, and really appreciate you being on here today and what you're doing out there in the industry. For those that want to reach out and, they're like, okay, hey, I want to have more conversation. I have more questions. How do they reach out to you and be part of what you got going on, my man?
If they want, I can get them my book I wrote called The Life You Deserve. It's a guide to obtaining prosperity and abundance. They can text the word wealth to 954-462-3300, or they can call us at that number. And if they want to have a 15-minute consultation, we'll be happy to do that. Text the word wealth to 954-462-3300. We'll get you our book and some other things. We'll get you what's called our prosperity pack. It's got some information on paying less taxes. It's got some information on how to maximize your Social Security with claiming strategies, a retirement checklist, as well as the book. And then obviously you can go to our website at singerwealth.com to check out what we have going on over there. But I think texting the word wealth to 954-462-3300 is the best way to get connected with us. We'll get you our weekly newsletter that I write, a column every Sunday in the Sun Sentinel, the Palm Beach Post. And it's pretty short and concise, but I get a lot of great feedback on it, so we can get you that every week as well with some good ideas.
Awesome, guys. And Keith, I really appreciate you making yourself so available. I'll put that number down there, and then as well as that link. I'll put all of his LinkedIn as well as his website down there in the description, so you guys make sure you stop what you're doing and reach out. He's been featured on all sorts of different things, like you can see there on the back, Money, CNBC, Forbes, ABC, all that fun stuff. So he's been featured a lot of good content out there, and also incredible prosperity package, which is really sweet. So I appreciate you making that available to our audience. Keith, again, I really appreciate you being on here. I want to ask before I let you go, you think about that young Keith and you think about the journey you are now and, looking back and being able to help hundreds of thousands of clients and, help generate wealth and sustain wealth and grow wealth, but also yourself, giving and being intentional. If you could think about that young Keith and imagine that young Keith, what insecurities did you have to overcome to become the successful Keith you are today?
If I'm going back to the young Keith talk, I know what I would say to that young Keith when you're starting out. I would say, A, find out what you're great at and just do that as much as you can and try to delegate the rest. B, find a mentor that's doing what you'd like to do. And even if you have to work for free, go offer your services. Say, I want to work for you. I want to learn from you. I want to help your organization. And I want to work for you for 6 months or a year. And if at any point you feel like I'm giving you value, you can pay me. But I'm not asking for that right now. What I really want to do is learn. That's when you're young and you don't have a lot of expenses. I remember when if I got $1,000 back in 1993, I was like, all right, I'm good for a month. I got my expenses covered. So you didn't need a lot back then. And so that would be the advice. Don't make your decisions about what you want to do, about what's going to pay you the most this year. Okay? Make your decisions about what's going to get you where you want to be in 3, 5, 10 years. Do that. Take that course. That's where you're going to get the most bang for the buck.
Well said. That is timely wisdom. Guys, that is my friend, the CEO and founder of Singer Wealth, the Untaxable Wealth Strategist, the one and only Keith Singer. Guys, that is Journey with Christian D. Evans podcast. Until next time, be uncommon if you can.